Good day, everyone. Hope you had a great day. And welcome to tonight's session, which is going to be amazing. Here speaking to you is Brendan, your mentor, the CEO of Sophia FX. So I'm going to go through some few parts, and I'll be reading through the comments. And the first thing that I'm going to talk about with you is how traders really make money. So many traders would tell you that they are making money from the market, but majority of the guys don't make money from the forex market. Majority of the guys make money from selling courses, and they don't really have the skills of how to trade the market. So many influencers are on social media that will be teaching you how to make money, but them themselves, they cannot trade the market at all. That's where you see in Sophia FX we create crazy results that people do not believe, that are impossible to the eye or to the naked eye, because our main aim is to create results and to produce results. Nothing more, nothing less, but results. So in this session, you are going to understand the fundamental basics of how the market works and how the market operates. Even if you are an experienced trader or you have no skills at all, this is the video that you are going to need to succeed in trading the market. This video is single-handedly going to make you semi-professional or maybe even professional. So it's very important that you stick around for the next few days, because that is going to help you to become a profitable trader. Okay, so I like going straight to where things are important. I'm not like other mentors that would go to you and tell you all kinds of stuff that sounds smart, and but at the end of the day, there's nothing useful coming out of there. So number one, the Instagram trading versus the real trading. The Instagram trading is fake. The real trading is actually where you have to go through a serious process to be vetted for you to become a profitable trader. Real trading is more like you going for a doctorate or you going for a master's degree, and it takes time for you to become a professional. The lie where many people have lied to people to say that when you enter into the markets you're going to make millions of dollars. Yes, it's partial truth, but it's also partial lies. There's a high chance that you'll be very profitable, and there's also a high chance that you will lose all your money because you don't know what you're doing. And that's where Sophia FX comes in, to help you so that you know what you're doing, semi understanding, and then later building a consistent understanding that will bring consistent results that are going to help you consistently to become profitable. And that's the very important, or that's one of the most important things that you need. But the human eye has been trained to believe what they see, and many people want to think that I need to see $1 million to be profitable. But $1 million are not made in a day. So that's why 90% of the people lose. So for me to be a useful mentor to you, you need to understand that you should get out of the bracket of the 90% of people that lose. Number one, discipline is your first strategy. Your first strategy is not you knowing how the charts move. Your first strategy is discipline. If you're not disciplined, you're not going to succeed in this industry. Number two, building patience. Building patience is a fast way on how you can make money. Yeah, if you build your patience in this fast world, you are highly guaranteed that you'll be able to make money. It is the impatient people that don't make money in the market. but it is the people that know how to be disciplined that are profitable in this market. Very important. All right. Emotional control, fear, greed, and revenge trading. Those are all your enemies. So what do you need in order for you to succeed? In order for you to succeed in this industry, you need faith, focus, and financial intelligence. I'm going to repeat. You need faith, you need focus, and financial intelligence. So instead of having fear, greed, revenge trading, impatience, and indiscipline, you need faith. Yes, you need to believe that God is going to help you. You need to believe that you're successful. You need to believe that you will be successful in this market. And with that, you put in action and you focus and you have financial intelligence. Financial intelligence is about how you manage your money. After you make 3,000, 10,000, 20,000, what are you going to do with that money? Are you going to be reckless so that you can start over again? So the reason why many people are not successful in this market is because they are always starting over again. There's nothing you are building. And that's why it always ruins your psychology. Because number one, you have a mindset of becoming rich quickly. And number two, you have a mindset of wasting money. You don't want your money to work for you. And that's what we are here for, to help you understand that trading is beautiful if you are doing it the right way. So it's better that you as a student must stop gambling and start thinking like a CEO. Think like you are running a business. Think like you're organizing your business. You are budgeting, you are planning a whole business. So every time you see profit coming in and every time you see a loss coming in, then you should know that I am managing and running a business. All right. So you should understand that the market is a battlefield, and it is only those that are structured that can become successful in this industry. It is only people that are structured, that have a disciplined life, that can survive in this industry. And you are one of them. That's why you are hearing this during the recording and also maybe after the recording. So no need to fear, no need to panic. I'm going to explain everything to you. So number one, what is Forex? All right. Forex is just the exchange of foreign currencies. All right. Forex is the exchange of different currencies. So we have different currencies in the market. All right. And all of those markets are written in specific ways. All right. So as you can see, instead of Europe, you will see something like this. All right. Instead of US dollar, you are going to see something like this. So it's not a written down, it's written in a shortened form. Instead of seeing Swissy, you will see something like this. All right. Instead of seeing Japanese yen, you're going to see something like this. Instead of seeing New Zealand dollar, you're going to see something like this. Instead of seeing pound, you're going to see something like this. So these are all individual pairs that you see in the market. Individual pairs. All right. You see them as individual pairs in the market. All right. So this is how they look like when they are individual. But once they become a full Forex trading pair, then you will start seeing something like, example, when it is a full pair that you're trading is Euro USD. Now this is these are now two different economies that are competing with each other. The first economy obviously is the euro, and the second economy is the USD in this case, because it starts with euro USD. Now this is the main currency that we are talking about. All right, so when you see something like this, then the main currency is the one that you see on the screen, this one, and this is just the currency that it is being compared with. All right, so that is the currency that it is being compared with right there. Okay, so when you're talking about euro USD, what moves euro USD? Number one is information on Europe. All right, like what? GDP, gross domestic product. All right, what are the other things? Interest rates. What else? Political events. All right, and also, you know, here we cannot say bank, we have to say the Federal Reserve. All right, the decisions that are made by Federal Reserve, like this over here. All right, so those are now one of the main things. All right, also other things like unemployment. So now this is euro USD that we are talking about, but now this pair is mainly affected by Europe. So when you are trading euro USD, now the main thing that we are talking about is euro USD. And when we are talking about euro USD, we are talking about the GDP of euro USD. All right, then we are talking about the interest rates in in Europe. Then we're talking about the Bank of Europe, the banks that are in Europe. Okay, if it is America, it is the Federal Reserve. And then we're talking about unemployment rate in Europe. So those are now called the fundamental information, fundamentals. All right, fundamental. All right, those are now the fundamentals. These fundamentals will help you understand the market very well. Now, when you are coming to this second pair that is here, the second pair is only regarded when there is nothing major happening on the first pair, which is this one. If there is anything major happening on the main pair, we regard the news on the main pair. But if there's something significant happening on the second pair, then we regard it. All right. So now, the market, what I just shared with you is what is called what? Fundamentals. Is the economical and the fundamental information of how you can rate a pair and how you can understand how the market works. Now, let's talk about things that, you know, ordinary traders look at. Like, for example, let's say that you are someone that trades other things. All right, other things like, you know, other things like gold. All right, other things like gold. So when you talk about gold, we're talking about now this is gold versus the dollar. Number one, gold versus the dollar. So the main currency is gold. Compared to what currency? The dollar. All right. So now this is not gold compared to the, Canadian dollar, or no, the US dollar. That's what it is compared to. So your understanding now is just to know, okay, there are two economies involved, gold versus the US dollar. All right. Now the US dollar is also named, the US dollar, okay, is also named DXY. All right. That's another name for the US dollar, DXY. All right. So whenever people are not interested in buying gold, they buy the US dollar. So whenever gold becomes a positive, US dollar becomes negative. Whenever gold becomes a negative, US dollar becomes positive. Because this pair is about gold and US dollar. It's only about those two pairs. So Forex is an exchange of two different currencies, or a commodity versus a currency. All right. Now, there cannot be anything like you see, you cannot expect to see the market operating in a way that doesn't make sense. Like for example, you saying that the market is showing you negative and negative. Nope, it doesn't exist. That doesn't exist. There's no instance like that. But one must be negative and one must be positive. That's how the market operates. Okay, I hope everyone got me up to there. I hope everyone got me up to there. Okay. So understanding currency pairs is the first thing. Okay. Now there is about $12 trillion running in this market daily. All right. So when you look at the chart, that's just an example of the other, markets that are there. So as you can see on my chart there, you see that these are all the currencies that are here on this market. These are all the currencies. Now, the combination of all of these currencies, the combination of everything right here, is what we call Forex. This is $12 trillion. So if you add all of those, there are only some here. It's not everything. So here you see Euro USD that I talked about. This is now Europe versus the dollar. Okay, the first you see is Europe, second you see is dollar. USD CAD, now in this case it's the dollar first and then the Canadian dollar second. The New Zealand dollar, this is now the NZD versus the dollar. So it's now different currencies against other currencies. Here you see GBP USD, which we were trading, which went even beyond. Whoa, that's crazy. So this is GBP USD. That shows now that this is Britain versus the US dollar. You cannot find for Canadian information on the British market. All right, the British market is the British market. That's how simple it is. That's how simple it is. So now with that information, or without foundational information that you have, you need to understand that your responsibility is to understand that the market moves only in two ways. The market has two states that it moves. The third state is not important. So number one, the market moves in an uptrend. All right, the market moves in an uptrend. Right, so upward movement. All right, so that upward movement of the market is also called long, or is also called bullish. All right, and then the other movement of the market is downwards. The other name for it is short. So the market is going short. That's not what we mean. And the other name is bearish. All right, so these are the names of the market movement. And then the last one is consolidation. So it's actually consolidation. So the last movement of the market, all right, the last movement of the market is when the market is moving sideways. It's not going up, it's not going down, it's just moving sideways. So now you need to understand this upward movement of the market is creating always new highs. All right, so it's creating new highs, up, down, up, down. So you always see that it's bypassing the previous high. So it's always bypassing the previous highs, and it is keeping the lows because it is an upward movement of the market. All right, so this one is upward. But when the market is in a downtrend, you see the market is creating new lows. All right, new lows. And then when the market is creating new lows, then you would see that the market is always taking out these areas because it's creating new lows and it's keeping the highs. So you see this high, then it does not take out the other high. So it's respecting the high. There's no high higher than the other one. All right, so in an uptrend, the market always creates new highs that are here. All right, and in a downtrend, it's creating new lows. All right, so you would see that it's creating lows here, and here it is creating highs. Those are the two characteristics of the different market movements. All right, the other movement of the market is consolidation. Now when the market is moving in a consolidation, you know what it does? When the market moves in a consolidation, it just goes sideways. It's not going up, it's not going down, it's not creating new highs, it's not creating new lows, it's just stuck in one place. And that's where we don't want to be involved. We don't want to be involved in that situation where we don't understand what the market is doing. That's the no trading zone. That's where we don't want to be involved in anything. All right, okay, so I explained to you what is forex. It's the exchange of different currencies, indices, and other pairs. All right, commodities and stuff, simple stuff. This is the simple understanding of forex. I don't need to go deeper into that and give a clear, definition. That's not important. That's like money is not, you don't need to know a lot for you to make money from there. Okay, now how the market moves, I just told you: uptrend, all right, downtrend, consolidation. That's how the market moves. So these are the terminologies that you need to remember for your trading. All right, so I want us to spot quickly uptrends and downtrends inside of this market. So I want us to spot uptrends and downtrends. Okay, so on this chart right here that you can see, you will see the price has been in a downtrend right here. So downtrend, that shows us the price created this high and then created this low and then created this high. You see, it did not take out this low right here. So this market is not creating, is not taking out this high. It's respecting this high and is creating a new high, but it's not higher than that high because it's a downtrend. So what is the new thing they're creating? Lows. So with this low, they made a low that is lower, but the high is not higher. So you see, this one is a high, all right, on the market right there. Sorry for my ugly writings. So you see that high being made right there, but the market is not going higher than that high because why? It's creating new lows. It's creating new lows. All right, it's creating new lows, and then price goes, creates this high that is not higher than this high, and then takes out that low. So now this is now the part where you need to focus a little bit. Where things change is here, exactly here. Why? Because the previous high that was created, that is not higher than this one, needs to be respected for price to come back and then go all the way like this and then to sell. But the market does not do that. It goes and takes out that high. The place where that high has been taken out now tells us that price has changed its direction. Now it's no more in an uptrend. Now it's no more in a downtrend. Now it became an uptrend. So instead of creating a high and then dropping while not taking out this high, it went above and beyond and took out the high. That now shows us the price is no more in a downtrend. All right, now it has created a uptrend just by creating that. Now you start seeing that there's a high, there's a low. All right, and then you see price going higher. So what is the next thing that we expect price to do? A low and then a high. That's the basic understanding of how the market moves. All right, that is the fundamental understanding of how the market moves. So when we are talking about the upward movement of the market, then we are talking about the market always creating new highs. When we're talking about the downward movement of the market is always creating new lows. That is the understanding of how the market operates, how the market moves. And once you have that understanding, you're far ahead of all the other people. All right, you're far ahead. So now I'm about to finish. I'm not going to be here for too long. All right, I'm not going to be here for too long. I need to, we still have tomorrow and we still have Sunday night for you to get all the important stuff that you need to learn. Now in the market, we have different sessions. All right, just like you have a day that is divided into, into three parts. You have the morning, you have the afternoon, and you have the evening. All right, so you have the morning, you have the afternoon, and then you have the evening. So the market is also divided into three. The market is divided into three sessions. Number one is Asia. Number two is London. Number three is New York. So those are the three sessions that you need to understand: Asia, London, and New York. Now, it depends on what time zone you are on. You can literally just go and check your time, and then you can see what time you're operating from. One quick way on how you can adjust your time in the market is by going on your trading view under here where you see time zone, and you can literally just select your time. If you are in New York, you can just select New York, and then you will see your time has changed on the charts. So let's just go to a lower time frame, and then you will see that here the time says that it is now 3 p.m. in New York. All right, so it's 30 minutes past 3 p.m. so it's like 3 p.m. in New York. All right, so if you want to change back to Central Africa, then you can change back. If you're in Los Angeles, you can change your time. If you are in London, you can change London, and then you see the time in London. Now the time in London is 2000 hours. All right, so that's how you can easily just adjust your time zone, and then you know, okay, when it is 8 in the morning in your time, then it is your session. So let's just say that you are in the London session, so you're 8 in the morning, which is 8 a.m. All right, let me put 8 a.m. So when it is 8 a.m. for you, like here, this time is 8 a.m. that means the London session has started. But now imagine this is London. If I change this to New York, you will see that this 8 a.m. is 3 in the morning. 3 a.m. 8 a.m. in London is 3 a.m. in New York. So if you look for the 8 a.m. in New York, all right, then you will see that 8 a.m. is when the New York session starts. So for you to understand, then you will see that the market bought in the London session, made a consolidation in before the New York session started, and then retraced a little bit and consolidated during the London session, and then the market started buying in the New York session. All right, and the same vice versa you do with the Asian session. So you see here it is 8 because it is the New York time zone. Hope that was very informative for you to understand the time zones and how they operate. So the market does not just act anyway. The market buys when a certain session is open, because then liquidity is provided. Like in this case, we are looking at GBP. So this is British pound versus US dollar. So Britain obviously is where the London session is. All right, Britain is where the London session is. So when you talk about Britain, you're talking about the London session. So when it is 8 o'clock in Britain, that's when the banks of London are open, and that's where money starts flowing in the London session. That's why you will see mostly when the London session opens, unless there's no bank holiday, unless there's no other funny news, but mostly news is used to do that, then you will see the market overreact and move fast because it's the opening of a session. All right, that's when you see it's the opening of a session. Then when it is the New York session starting, again you see a lot of movement also. So you can backtest this on your charts, and you can basically start seeing what I'm saying is making sense. All right, so now we're on the New York time frame, all right, time zone. So check 8 o'clock in New York. All right, when the New York session starts, see what happens. Market goes up. All right, and when we select the time for London, which is 3, you see market just makes a small adjustment and then goes up. So when the session starts, there's a movement for that direction to cater the market for that direction. All right, so it's very important that you understand these things, because these are the things that you need to be a profitable trader. You need to understand the time and how the market moves during time. All right, now I need to understand, I need to make you understand, all right, that there are actually 3 or actually 2 types of traders. All right, there are 2 types of traders. We have 2 types of traders in the trading industry. Number 1, we have the retail trader. All right, number 2, we have the institutional trader. So institutional trader is someone that trades the market with high volumes. All right. And a retail trader is someone that trades the market with low volumes, does not have any impact, any effect on the market, trades very low money, needs a broker to execute a trade, cannot execute any trade on their own, cannot make the market move the market. So a retail trader does not really make the market move. A retail trader is someone that is extremely invisible. I hear many retail traders saying that, oh, the reason why I got stopped out is because the banks hate me. The markets are fighting me. Nope. The markets don't care about the retail trader. The retail trader is not important to the markets. So I hope you understand that, and I hope it makes sense for you. All right. That a retail trader is someone that deposits money into the bank and trades through a broker. An institutional trader is mainly someone that operates with a liquidity provider. All right. And many people that present themselves as institutional traders are just writing on social media as if they are institutional traders, but they don't even know what institutional traders mean. All right. So retail traders are food to many institutions. Why? Because retail traders think small. They think according to their bank account, and they don't think being beyond their bank account. They only think about their $100 that they've deposited. So you will see $100 deposited, or you will see them depositing 1,000, or sometimes you see them depositing 1 million, and they think according to their emotions. They don't think according to the real market that is running with $12 trillion daily. So retail traders, because of emotions, because of revenge trading, because of fear, greed, revenge trading, indiscipline, are always prey for the market. The market loves them because the market makes money from them. That's why there are many brokers opening every single day, because they are making money from the retail trader. 90% of traders fail 90% of the time in 90 days. So when you deposit money into the broker, you should know that it takes 90 days for the broker to know that if you are a profitable trader or not. If in the first 90 days, if you don't blow your account, the broker will trust you. But if in the first 90 days you are very profitable, you see a lot of money, you see a lot of movement in the market, and you are happy, trust me, it will just take you 2 months, and then you feed the money back again to the broker. And the brokers are not stressed. The brokers are not stressed when you deposit money and you make money. So the brokers will never manipulate, because they know retail traders think small. They don't think far ahead. They don't plan. They don't have a target. You see, that's why I said you should think like a CEO when you're approaching the market. All right. Think like a CEO. Plan the next 12 months or 6 months or the first quarter of the year. First quarter of the year, first 4 months of the year. How much are you planning to make? Second quarter, how much are you trying to make in the next 4 months? And then the last 4 months, how much money do you want to make? That's how professional traders think like. And retail traders can never go to that extent unless they stop thinking small. All right. So the other reason why retail traders are food to the brokers and to the market is because of what? Spread. So spread is something that you will see in the market, that when you are trading, the market opens wide and then just eats all your money. That's what we call a spread. Slippage is one of them also. Slippage is a tool that the market uses to manipulate your trades. How? Whenever you are trying to open a trade and there is a fast movement in the market, you see that where you bought is not where the market is buying. The market buys at a position that is far away from where you wanted to buy. That's how they manipulate with slippage. The last one is when you have a mindset that you will make $1 million in a day. All right. So when your mindset is messed up, so when your mindset is messed up, then we know eventually you are going to be one of the people that are going to be feeding the broker like never before. So I am someone that is here teaching you that has the capabilities of doing crazy stuff in the market. I'm one of the people that can take $50 to 2,000, $50 to 3,000, $50 to 500. So like my results are there. You can just check it out. Go on my social media and check it out, and you will see that I make a lot of sense when I speak about this market. It's because I understand one thing that you do not. I have mastered this market and I understand the market. And this first session was to give you a simple but a very important understanding on how the market moves and how the market operates. It's very important that you understand these basics, so that if I'm going live tomorrow I'll talk more in depth, explaining to you how the market actually is traded and how we look at the charts and analyze the market. And I'll also give you a free strategy that you can use. And if you feel like you want to rush the process and you want to go straight into the mentorship, you can just go on our website, sophiafx.online, and you can basically start trading the market. With that being said, have a blessed and a beautiful day.